Okay, we're now going to take a look at exercise 1812, page 1107. And here we're dealing with share retirement. Now, what we mean by that is a company goes out in the open market, purchases some of their own shares, but rather than holding those shares as treasury stock, they retire the shares or take them out of circulation. Completely out of circulation, they're not even owned by the corporation themselves. It's like those shares don't exist anymore. So it's really kind of an opposite journal entry to the issuance of the shares. It's just we can't run a negative or debit balance in an equity account paid in capital in excess of par common stock. So if we need to debit it for more than what was originally placed in the account, we'd have to go to our retained earnings account. So let's go through this one. I think this should be kind of interesting, and then we'll look at some treasury stock transactions as well a little bit in a later exercise. Okay, exercise 1812 on page 1107. In 2016, Borland Semiconductors entered into the transactions described below. In 2013, Borland had issued 170 million shares of its $1 par common stock at $34 a share. Okay, we're going to need that information to know what the shares went on, at the price the shares went on the books at. It's $1 par, and then if they were sold for $34 or issued at $34 a share, then $33 per share went into paid in capital in excess of par common stock. So it says handle these as if they're all separate transactions, right? So we're in 2016. And we're at January 2nd. Okay, what needs to come off the books? Well, the common stock goes on the books as a credit. It's an equity account, would come off the books as a debit. And it's going to come off the books at par value. All right, so 10 million times the $1 par, or $10 million is our debit to common stock. Well, our paid in capital in excess of par common stock if you look back in 2013, we issued the shares for $34 a share. $1 of that was par value. So the paid in capital in excess of par common stock went on the books as a credit back in 2013 for $33 a share. So now it needs to come off the books at $33 a share times the 10 million shares. And we get $330 million. Okay, what else do we know? Well, we know we'll need to credit cash for the amount we paid for the shares here on January 2nd, 2016. How much was paid for the shares? $10 million at $32.50 each. So we get $325 million. Okay, we need more credit to balance the entry, so we now have a new account called paid in capital share repurchase. and that's just going to be the difference or whatever it takes to balance. So we'll say the 10 million plus the 330 million minus I6 there. Again, we're playing bingo, and that's $15 million. Okay, so that's a share repurchase, and then their shares were retired, not held by the corporation as treasury stock. Instead, they were taken out of existence, if you will. Okay, now we're still in 2016. On March 3rd, Borland reacquired 10 million shares at $36 per share. Okay, and this is on March 3rd. Okay, again, we'll debit common stock. For this time 10 million shares again. Times the $1 par value that they went on the books at back in 2013. Okay, we'll also take paid in capital in excess of par common stock off the books. Went on the books as a credit, comes off as a debit. Well, it went on the books as a credit for $33 a share, the 34 minus the $1 par back in 2013. So it comes off the books at that same amount when the shares are retired. It's 10 million times, we could say 34, the issue price minus the $1 par. So far no change from above. Okay, how much cash did we give up? And you guys, these transactions are not independent of one another. I may have said that earlier. It's just a continuing flow of transactions for Borland Corporation throughout the year. Okay, cash given up on March 3rd, 10 million at 36. $360 million. Okay, and what do we have over here? 340, so we need more debit. Well, we can wipe out this account balance. We put paid in capital share repurchase. It's going to be debited here. We put it on the books as a credit. We can wipe out that equity of 15 million. Now do we balance? We've got 355 million on the debit side, 360 million on the credit side. You guys, but we've wiped out the credit balance in all of our paid in capital accounts. Paid in capital share repurchase and paid in capital in excess of par common stock. This balance was wiped out from when the shares were issued originally. This balance was wiped out from back on January 2nd. So now we don't have another paid-in capital account to debit here. So we'll have to make up the difference to retained earnings. And that's going to be equal to 360 million minus 15 million minus 330 million minus 10 million. $5 million. Okay, and then we go to number 3 on August 13th. What happened here? Borland sold 1 million shares at $42 per share. Alright, these are new shares that are being issued. You're familiar with this one by now. Borland Company is going to receive cash. How much? Well, $42 per share times 1 million shares that were issued, or $42 million. We credit common stock for the par value, 1 million times the $1 par. And that gets us $1 million. And then we're going to credit paid in capital in excess of par common stock for the difference. It's equal to 42 million minus the 1 million, or $41 million. Okay, a similar transaction on December 15th. We're going to debit cash for the amount received on December 15th. Borland sold 2 million shares at 36 per share. These last two, you guys, are nothing different than you've seen before. These retirement entries on January 2nd and March 3rd were somewhat different. Kind of opposite transactions. Just remember, we debited retained earnings here because you can't run a negative or debit balance in one of your paid-in capital or any stockholders' equity account. Okay, so cash received on December 15th would be 2 million shares at $36 each. Or 72 million. And these two accounts will be credited. We'll credit common stock for 2 million shares times par value of $1. And our credit to paid in capital in excess of par common stock would be equal to cash received minus par value of 2 million. Gets us 70 million there. And later on, if these shares were retired, we'd use the $42 a share. Or if these shares are retired, we'd use the $36 a share. Hope that one works well for you. I think if you work that with me, you shouldn't have any trouble with the exercise 1812 and Connect. If you do, please be in touch. Thanks.